Okay. How are we today, guys? You're tired. I'm also tired. I am also tired. How are we going to get through the day? Hmm? You hear the vibe? I'm here till 12. Oh, I didn't join it. Sorry, that's on me. Let me quickly sort that out. Okay. Right. So I just want us to do 1.5 question. Question 5 is actually lighter than 1. So depending on how we feel after we do 1.5, you guys will let me know. If you're feeling confident about it, then we'll just discuss question 5. All right. Okay. So let's get into question 1.5 first. Right. So under the required, they ask for quite a few things there from us. Firstly, they say calculate the cost of each source of capital funding. Okay, that's something we've been doing. Then secondly, it says calculate the break point associated with the company's financial situation. Okay, that we haven't done, but we discussed it in theory. Calculate the weighted average cost of capital associated to the total new financing below the break point calculated in part 2 above. Then it says calculate the weighted average cost of capital associated with the total new financing above the break point calculated in point 2. Okay. Using the available information on a single graph, prepare the weighted marginal cost of capital schedule and the investment opportunity schedule. This is why I wanted us to do this question. Decide which investment opportunities the company should undertake. The company should undertake. Okay, so now we know what they want us to do. Let's read through the question. Sherbet Limited has enlisted your help in determining cost of capital. Sorry, its cost of capital. The financial controller of the company has collected the following information about its various capital structure components. Right, retained earnings. Okay, so that's the first component. The company will only raise funds through the issue of new ordinary shares. Once any existing retained earnings have been exhausted. Okay, so we'll only use new ordinary shares. In other words, we'll issue new ordinary shares only if we exhaust the retained earnings. It is expected that retained earnings of 250,000 will be available next year. Okay, so we already have 250,000 available next year. Okay, if we need more than that, that's when we're going to issue shares. The company anticipates paying a dividend of 15 Rand per share in the forthcoming year. The company's annual and continuing expected dividend growth rate is 4% per annum. Guys, as you're reading these questions, you can already see there's a lot of content here. I would already be marking 4% growth rate. I would already be marking expected dividend, in other words, D1, to be 15 Rand per share. And then you've got the 250,000 available for next year. Okay, retained earnings. I would really single that out so that I don't have to come back and read that stuff again. Does that make sense? Then we go to the next component. So if you look, actually, I've also done that for us here. Pertaining to each component of our capital structure. Right. So ordinary shares. The company's shares are currently trading at a share price of 150 per share. Okay. If the company were to raise funds through a share issue, it will have to discount the share issue price by an average discount of 5 Rand per share, plus pay expected flotation cost of 5 Rand per share. The extent of capital that can be sourced through the ordinary share issue is considered unlimited. Okay, so here we don't have any limitation. Okay, then corporate debt. The company can raise corporate debt through the sale of 2,500 par value corporate bonds. Okay, so the par value on the debt or on the bonds that we would potentially utilize, 2,500. At an average discount of 50 Rand per bond, and with a flotation cost, with flotation costs of 25 Rand per bond. The corporate bonds pay an annual coupon of 10% and have a maturity of 10 years. Okay, so there you can see we have quite a few important details when it comes to the corporate bond. We obviously have the par value. We have the average discount. We have the flotation cost. We also have the term, which is 10 years. I didn't write that down somewhere. So let's just quickly do that. Term. Okay. Maturity is 10 years. Whichever one works for you. It's behaving this whole week. Okay. Anyway, last thing that they say there, the extent of capital that can be sourced through the corporate bond issue is considered unlimited. Okay. Right. So no limitations there. Then preference shares. The company can issue preference shares at a par value of 200 Rand per share, per preference share, and with flotation costs of 5 Rand per share. The preference shares pays a dividend of 11%, 11.5%. The extent of capital that can be sourced through the preference share issue is considered to be unlimited. Okay, and then here you've got the company's target capital structure is made up of the following. So there's our structure: debt, preference shares, and equity. Okay, and then the table below summarizes the company's current investment opportunities. And then at the bottom there, they're just informing us that our tax rate is 28%. 28%. Super. So we then have to begin with part 1, where they ask us to calculate the cost of capital for the different components of funding, right, or sources of capital funding. So the first one that we read there was the retained earnings, isn't it? So now what is the formula that we can use when it comes to equity? 2 formulas, isn't it? Dividend growth model and your CAPM, isn't it? Right. So here today, tell us about the risk-free rate. So we only have what to make use of? The dividend growth model. Okay. So what does that formula look like? We're saying RE, isn't it? Is equals to what, guys? Tell me. D1. Yes, and then K minus G. Yes. Okay, we can use K minus G. If we don't use K, what's the other one that we use? Is this correct? Yes. Divided by PO, isn't? Plus G. Is that right? Okay, so then when we have that, can you see we've already said the key information that we need, right? So now all we need to is just plug in the values and calculate the cost of capital there, or the interest rate. Okay, so D1 they gave us, they said it's 15. And PO, we find out from the next ordinary shares there, is 150. Right? Just do that. And then plus 0.04. Sorry, don't need to do that. So what is the return that we are getting? Yes. So this should give you 14%. Everybody happy? Okay, so we've got our first one there. Then we go to the next one. The next one is the cost of new share issue. This is assuming that we end up needing to generate more capital through selling new shares or doing a new share issue. Okay, so what's the formula there for a new share issue? Yeah, so again, here you're going to have RE is equals to, as you mentioned, D1 over NE. Okay, and again, this is going to be plus G. Okay. Let's just create some space. So let's calculate this here. So we know that our dividend, they gave it to us. What did they say? Wait, let's just look here quickly. What is our dividend? Discount. Da, 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 da. Yeah, okay. So our dividend, we're using the same dividend, 15. Ooh, right. And then NE, how are we getting NE? It's our net proceeds, yes. I'm hearing whispers. Why are you saying 150? Yes. Uh-huh. But is it only the flotation cost that we need to deduct there? What about average discount? Minus the flotation cost. Yeah. So I imagine that it should be the 150 minus the flotation cost, then minus the discount. Because remember, net proceeds, we're saying, this is just to make sure we're all together. We're saying, if you look at the previous calculation that we did, where we were looking at ordinary shares, right? The cost of ordinary shares, right? That we already have, or retained earnings. Okay. We said the expected dividend divided by the price of the share. You see that, right? So we know the price of the share is 150. Okay. But we're saying if we issue new shares, we're going to have to sell the share to make it attractive at a discount of 5 rand. And then there's the flotation cost, okay, which I imagine is the admin of actually issue of another 5 rand. So the net proceed is then obviously 140. We together. Okay, but I'm going to write that out here with 150 minus R5 minus R5. Is it making sense? Okay. And then plus our growth rate of, what was it? 4%. Okay. And what do we get over there? What are we getting over there? 14.7. Okay, super. All right, that sounds familiar. That sounds correct as well. Everybody happy so far? Yes. So you have to actually understand what's happening in the formulas, why you're doing what you're doing. Because you'll see here, remember yesterday, well, those that were here, we were dealing with convertible corporate bonds. In this question, we're dealing with just regular bonds. How we treat those is different. Because remember, with convertible bonds, we're saying at the end of the term, Thomas, you can convert the bonds you have into ordinary shares. And obviously, if it's favorable for you to do so, you will convert it to ordinary shares, as opposed to just getting the par value. That makes sense. But if it's just a regular bond, you don't have that option. That makes sense. So, yes, it's a long way of saying yes to what you just said. You need to not only know the formulas, you need to understand them. And then, based off of the information given, know, okay, this is the formula I should use in this. Give your home and draw. I actually like this. I think this is a very interesting topic. Okay. And yeah, if you're interested in the world of investments, even finance, because if you just decide to move into finance for a company, assisting them in that space, you need to know the different ways that you can fund the company or obtain financing, because all businesses need financing at some point, whether it's for the short term or long term. So I think it's very interesting stuff. Okay. That said, let's now move on to the next source of financing, which is our corporate debt. Okay, with our bonds. Information that we have, we know the par value or face value, yeah, as we used to call it. 2,500 average discount per bond, 50 rand. Flotation cost per bond, 25 rand. We now also know that the term is 10 years, so this is only maturing in 10 years. Okay. So now, how do we calculate the cost of this bond? How do we calculate the cost of this? The same way we will calculate the return by looking at the cash flows, isn't it? Okay, so first things first. As a business, when we issue bonds, we are going to receive. I sell a bond to this gentleman here. He's going to pay for the bond, isn't it? That's going to be a cash inflow, isn't it? But then I have to give him annual coupons, which is going to be cash outflows, isn't it? Okay, so we now need to calculate and find out how much are we paying by way of the interest rate on this bond. So first things first, the income that I'm going to get from it, how much is that? They told us that the par value is 2005, but that has a discount, right? I'm selling at a discount. I'm not selling at the 2,500, right? So that means that we have 2,500 minus 50 Rand discount, okay? And then minus the 25 Rand flotation cost, which then tells us how much is the price of this bond currently. Thank you so much. Okay. All right. I was going to do the calculation that we just did in brackets over here. So if you're writing, we should do the calculation in brackets. So, all right, cool. Then we know that Fabio, in 10 years, we're going to pay him 2.5 because that's the redemption value. Well, that's the par value. Isn't it? So cool. But then we also have the coupons. Thank you, thank you. Okay. But now we also have the coupons. So I just did this calculation because we were doing this yesterday. So I kind of was like, I don't want to waste time on this because if we spend too much time here, we might not get through the new stuff that we need to go through. So if you look at this line here, it basically is showing you how we are calculating the coupon interest payments. And we'll just discuss it. So we know from the question, I actually didn't write it down, but the coupon interest is 10%. Okay, so we also know that we calculate our coupons based off of the par value. So the 2,500 times 10%. But then we know since we are a company, right, we can get a deduction on interest payments, isn't it, as a company? So we then say, okay, then we're not paying that full 2,500. We're going to pay only 72% of that because our tax rate is 28%. Okay, so 0.72 times the 250. All right, and that's how we're getting this 180. Everybody happy there? So every single year, CD, my bond holder, we're paying you 180. Very nice investment. You can do a lot if you're 180. It's changing your life. 180 a year. Okay. So, and this is where you guys need to be very careful. The cash flows. Because if you get these cash flows wrong, then your interest rate calculation is pretty wrong. So we have 2,425 Rand coming from Fabio and CD. So they purchased our bond, so that's the income. Then we are paying them 180 every year. And then at the end of year 10, we're paying them the 2,500, right? And we're paying 180, isn't it? Which is one coupon. So that's fine. Can you see with the convertible bonds? That's exactly where I'm going. Can you see yesterday, we were doing year 1 to 9 because our bondholders were converting their bonds into shares. So they were declining that coupon payment in year 10. Can you see that? Oh, actually, you mean as in actually here, written out. Yes, you're right, sorry. That's a typo. That's a typo, sorry. That should be 9. Because I've added the 120 to the year. Yes, thank you so much for that, Thomas. Okay. So, what's our IRR? What's our cost of capital? You guys get it.
So you think I'll give us 10 views in the exam? How many is the tips?
They could give you 10, they could give you 5.
10 catchments.
Yeah, that is a lot. I just think it will be about the length of the question. If the question is short, remember this exercise is longer than that. So if the question is short, they could give you 10 minutes. But it's not necessary because at the end of the day, if we give you 4, if you know the principles. So, yeah. So I don't think it's necessary.
What we did yesterday.
Yes.
We did it last year. How did that for me doesn't make sense.
What type of payment do we count?
Say a lot like in year 10.
Yes.
We didn't.
Give a coupon.
Yeah, give.
Yes.
Just for me that doesn't make sense, right? If we had a 10-year period, give it. And then on the last year, see we were going to give you was going to just.
Have you guys gone over options? You go over options in 3. I think you only go over options later in this text. So with an option, right? An option is not an obligation to execute or
Is it at the right of the beholder?
yes, it's not an obligation, but it is a right. Okay, you have the right to convert your bonds into shares, but you're not obliged. Does that make sense? Now, by virtue of converting, you are then declining that coupon in year 10. Can you see that? So it's up to you. You can take the coupon if you want in year 10, or you can get the shares and we'll pay you the value of the shares.
Like get the audit then after that year.
Because that last coupon is the last financial commitment we have to us. We no longer owe you anything. Right. So what's the interest rate that we're getting here? Very good question, because they could ask you to do a convertible bond or they can ask you to do a regular bond. So you need to understand why are you not including the coupon payment in year 10. And remember what we were saying yesterday. What is the likelihood that this person is going to convert? Sometimes you guys will find a situation where the shares, the value of the shares that you could convert to is less than the coupon payment. So you're not going to convert it that means. You'd rather take the coupon payment, and if you really want to invest in this company, you can buy the shares and still have some change. Can you see? So you then also need to understand what does it mean when we say they are likely to redeem the bond. It means they're going to decline the shares, which means you will have year 10 coupon. Fun times. So what's our interest rate? 7.67. Is everybody getting that? 6.4. Okay. Right. Having said that, If you check in your textbooks at the back, the answer there is 7.65. Let's double check. Because it's 6.24. Let me also just check. Let me also just check. Just check there in the back of the textbook.
They got 6.5.
They have 6.5. All right, I'll explain what I wanted to say just now. Yeah, but when I did my clear my calculation. When I did my calculation, I was also getting 6.4. But I'll explain why that is the case. Yeah, so again, rounded off, I'm getting 7 points. Now, if you look at the back of your textbooks, they use what we were talking about yesterday. I feel like I butchered this word. What is it? Interpolation. The guessing. For this method, if you can do it by your calculator, because it's always time. Does that make sense? You're going to do 2 cash flow estimates at the very least. I guess 9%, I guess 8%, and so on and so forth. And then they just do 2, but in reality, you might need to do more than just 2. Does that make sense? So I'm looking at, I'm saying, because I'm losing time, I could be spending time on something easy that they know, rather than guessing on something that they may or may not get. Does that make sense? So we'll see in the past test if they ask us to ever use that, then we'll delve into it. But otherwise, my advice is just get your IRR and aim off a drug. Okay. Now, obviously, because they're using that method, then there's obviously just that 0.01 difference. But we're not going to say something that is not should not be recorded, but yeah, you're going to get your marks. 0.01. So don't worry about that. So now I think, do we have all our costs of capital? No, one more. Sure. This is turning out to be. So let's just quickly calculate this, and then we'll take a breather. And we'll take a breather. So preference shares. How do we calculate our cost of capital? Yes. What's our formula? Somebody. RP, yes. DP. And DP is your dividend on the preference share, isn't it? Over NP. Okay, and NP is what? What is NP? Your net proceeds. Oh, here we go again. Okay, right. So, what is the dividend on our preference shares? We're obviously taking our par value of 200 times the 0.115. That is a very strange looking 5, but oh well. Then our flotation minus the value or our gross proceeds. This is how we get our net proceeds. It's pretty much the same as with the if we're to issue new debt. So 200 minus the 5. Did we issue these at a discount, by the way? There's no discount here. Okay, that's fine. Okay. So what are we getting as our answer over here now? Is that it? Did they say? I don't think so. I don't think so. Let me just check if they remove text. Wait. It's a payment that we made. Yeah, just double check it. Yeah. Could actually be paid. Could actually be paid because that's an interest expense to the company. Just double check there.
They don't tell you how they got it, they just say 23.
So the answer is 23 rand. Okay, so let's just see. They didn't remove anything. Yeah, those are the small things that you need to make sure. So 23 divided by 195, isn't it? And what do we get? What's our final answer? That is a relevant question. Let me investigate. And then I'll get back to you. Say one thing. So what ChatGPT is taking that? Let's quickly see. We're saying why are preferences the dividends not deductible tax? Like they might say taxing the hands of a holder. Dividend holder, but I'm sure that's the way. It's also worth it.
People will consider a distribution of corporate holiday expense is one. Debt versus equity. Each of those debts is tax deductible of every contributions of points. And the chief is given.
I was going to ask that question. Did you see? Interest on debt is not interest on payments. So that's the reason. So
I'm saying there's 2 billion. Like
So this is why we say it's cheaper to raise funds via debt because we get a deduction. With equity, we don't get a deduction. You see that? Okay. So preferences, it falls under equity, although it's not full ownership. Okay. Right. Hey, very good. Learn something every day. So I think let's take a break. Then we'll be back by 5 o'clock. I think we will at the very least finish this exercise, which is fine.
So you should report yourself.
You want me to stop it before?
Yeah.
Okay.